Welcome to Capitol Creek's 3 in 10 podcast. Today is June 6th, 2025. I am your host, Scott Slayton, strategist and partner at Capitol Creek, a multifamily office in Austin, Texas. Here are 3 things we think investors need to understand this week. First of all, the MSCI All Country World Index makes a new all-time high. Number 2, the Labor Department's non-farm payroll report shows the labor market in the U.S. is undergoing a benign cooling. And number 3, platinum and silver prices explode this week. Let's start with the first item. ACWI makes a new all-time high for the first time since February. I've often thought that the most bullish thing a market can do is go up and make decisive new all-time highs, and that's exactly what happened this week with the all-encompassing global all-country world index. The index is now up 6% on the year before currency. So for dollar investors, the index is up well into double digits. Why? How can this be happening at a time of such turmoil and uncertainty? Well, I think it's because the U.S. economy is a super tanker. It's hard to knock off course. Even a global trade war may not be able to knock it off course. And the global economy is hanging in there quite well. Global interest rates, policy rates, are undergoing a cutting cycle that's been going on for quite some time now. We don't notice it as much here in the U.S. because the U.S. is really lagging the global easing cycle. Yes, we are in a global easing cycle, and almost certainly the next move will be another cut. But it doesn't feel so good because it's been a long time since we've had a cut. And that timetable just continues to get pushed out. The global fiscal cycle is still positive. We see this in the way that the U.S. is running $2 trillion deficits, 6-7% of GDP. But let's not forget that China has been in a positive fiscal cycle, getting ahead of the tariffs, stimulating consumer demand, cutting interest rates. Europe, Germany is a good example. They're going to raise defense spending to the highest levels as a percentage of GDP in many, many decades. So there is fiscal stimulus going on in other parts of the world outside the U.S. because those countries, of course, they know we're in a trade war. So they're trying to insulate themselves with monetary and fiscal policy. That's not really happening to the same extent here in the U.S. And the U.S. is the clear equity laggard by margins I've basically never seen before in my long career. So we've got many of the European markets up well over 20%, and we've got the U.S. up a little bit for the year, just a little bit better than flat. I'm beginning to expect a catch-up phase by the U.S. in the second half of the year. Markets are doing a really good job of ignoring the trade noise, ignoring the budget concerns, ignoring the petty feuds between Trump and Elon Musk. The market trades great on bad news, and it trades really well on good news. So this market trades like a new bull market was formed in early mid-April. Fight it at your peril. Point number 2, non-farm payrolls this morning. A cooling labor market, a benignly cooling labor market. In fact, I'd call it Goldilocks. Not too hot, not too cold, darn near perfect. Equities today were happy and rallied because the market was a little stronger than expected. The market's been very nervous about the labor market cooling rapidly and having the bottom fall out of it. That's not happening. I like to look at the 3-month moving average, and it came in at a moderate positive 135,000. That's really good for an expansion that's been going on for a while. 2-month revision factor, of course, was negative 95,000. That's cooling, though. And remember, when the labor market cools, it allows the Fed to come back into the game because it's disinflationary in nature. U3 unemployment rate steady at 4.2%. It's been between 4 and 4.2% for the last 9 months. And the U7, the so-called underemployment rate, steady as she goes at 7.8. If I were to find a fly in the ointment of this report, it would have been an average hourly earnings, which ticked up 0.4% in May. But the year-over-year figure at 3.9% is still acceptable. Average weekly hours have been so consistent, right around 34.2 to 34.4. We're right in the middle of that for the month of May at 34.3. That's a good indication. And where are the jobs being added? Well, they're being added consistently in the same places month after month. Education and healthcare continues to add a lot of jobs. 87,000 jobs were added to these areas in May. Leisure and hospitality also remain an engine of employment, adding almost 50,000 jobs during the month of May. And where are the jobs not being added anymore? Government. Interestingly, government added a huge number of jobs and very consistently added jobs between 2021 and 2024. Perhaps this will be the lasting legacy of Doge after all, that we just stop adding employment from the government. That might even be considered a positive. We'd rather have more private sector jobs, which are more productive than government jobs. So this report is bullish for risk assets. It's a beautiful slowdown. Rate cuts are coming in the second half of the year. The stock market understands this and is rallying on this. Our third topic this week comes from the commodity markets. Platinum and silver exploded this week, had great weeks. Silver was just outstanding and is starting to catch up to gold. But we had Platinum Week in London last week, and that jolted platinum into action. This is a sideways market for over a year, just doing nothing, and got all the way down, trading at less than a third of the price of gold, when for years, decades, it had traded at a premium to gold. Silver has woken up too and playing catch up to gold. Today, on the 6th of June, 2025, we have the highest prices for silver since 2011. We're still light years away from the all-time high, the nominal high, in 2010. It was made 15 years ago at $50 an ounce. We're at $35 an ounce. So there's a long, long way to go in a silver bull market to make new all-time highs. Platinum and silver have industrial demand. And I think that's part of the reason why they're rallying. There was so much fear about recession. There was so much fear, especially about a goods recession, which is where, of course, the tariffs are concentrated in goods, not in services. And I think there's some relief in these metals. I'm also seeing it in aluminum. I'm seeing it in copper. I'm seeing it in other economically sensitive metals, that things just aren't that bad. And the odds of recession, which felt so heavy 2 months ago, are lifting. So stronger platinum and silver prices tell me that a recession is still not the central case. And positioning. I'm looking at positioning in silver, and it's not stretched at all by historical standards. So maybe the devil's metal has a ways to run. Maybe this is the beginning of a new bull market for silver. And maybe it's a beginning of a new bull market relative to gold. So the silver-gold ratio, which I've watched for decades, is still, even after this rally, still near the lows since 1950. You can buy almost 100 ounces of silver for every ounce of gold. Gold makes up a little more than 1%. I mean, silver prices make up a little over 1% of the price of gold. So central banks don't really buy silver or platinum, and they're the ones that have been driving gold prices higher and higher. So central banks don't buy silver or platinum really, but specs do. And they're starting to wake up to these two metals that have been huge laggards relative to gold. So There it is, your 3 in 10 podcast for June 6, 2025. Please check out our website at capitalcreekpartners.com to view our written work and webinars, other media. And until next week, be careful out there.